Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. While the markets were anticipating something from Powell's speech, the event turned out to be rather uneventful with no mention of monetary policy. But that didn't stop the yields from retreating lower. On the geopolitical front, the Israeli defense forces are in the heart of the Gaza city, but there doesn't seem to be much of a reaction to that on the markets front either. Good morning, JK. Can we confidently say we have seen a high in the yields? What do you think?
Yeah, good morning, Swaraj. Yes, that is the sense I am getting because the U.S. economy is showing uh, good signs of slowing down. Whole of last week we received data which was weaker than expected, and while this week we have much lower you know say, list of data. One point that came across was that the mortgage rates have also fallen this week, and that's also it can have some relation to the yields falling, but it also shows that the housing demand is very low, and in fact the data shows that affordability is at its lowest level for more than a decade. So yeah, I think 5% on 10-year is definitely not going to be breached very easily in the coming months, or rather in this cycle itself, I would say. No, but otherwise, the markets had very little fresh clues to chew on yesterday. And even Chairman Powell, as you said, failed to provide anything to react to in his scheduled speech of conference yesterday. Eurozone retail sales was one number that was on the focus, but it came mixed. Month-on-month basis weaker, and year-on-year basis posted a better number. Meanwhile, the 1-year ahead CPI inflation expectations in the Eurozone has risen to 4% from 3.5%, but not much of a reaction for these things. Yeah, as I said, the mortgage rates on US residential accommodations plunged to nearly 16 months low. In fact, it plunged most in the last 16 months. So that there was some relief for probably the home buyers at 7.61% versus 8% that was seen earlier. Yields had very little movement, but it was generally well capped, on both the 10-year and the 30-year, waiting for more clues. We should be getting more clues next week with the CPI number due from US. We'll also have more data from UK side. Now markets latch on to anything that is weak as an economic number from either Eurozone or UK or China to keep the yields lower. Today, in fact, we had the Chinese CPI number, which was weaker than expected, and both on year-on-year and month-on-month. So the deflationary forces are still at play as far as China is concerned. So the price pressures are reducing across, that will keep the yields lower. In fact, the oil prices have decisively broken even 80. That's the Brent I'm talking about, and that should be a great comfort for the policymakers as far as the inflation trends are concerned. As for the stocks, they meandered in a range, ended mixed for various indices, but nothing directional has emerged. S&P 500 and Nasdaq once again closed in the positive territory. It's the longest run for both these indices of 9 days of gains. Otherwise, European markets were faring better yesterday comparatively. On the currencies, dollar respected the strong resistance at 106, fell back, and on a perceived underlying weakening trend taking over, but need some more confirmation to see whether we see a broader sell-off in the USD. Yesterday, it was quite mixed. Commodity currencies were weaker on perception of weaker global growth. Yen was trading near 151 as more, confident that Bank of Japan is not going to intervene immediately. So that keeps the overall dollar picture mixed, but euro and GBP definitely overperformed. I would say they performed better than other currencies. On the yen, an interesting thing is that the option bias indicates a preference for downside of USD yen, as risk reversals are skewed to the puts. And speaking of oil, across financial assets and commodity price complex, oil continues to show the most volatility. Crude oil benchmark carrying 2.5% drop to the 4% drop that was seen on Tuesday, reportedly on deepening pessimism about the demand and the global growth as well. Rupee is, of course, looking more and more delinked from the global currencies or economic developments. Neither the fall in the dollar post NFP nor the recovery this week have affected rupee's prospects in a non-trending behavior. Constant demand for dollars near historical highs is somewhat surprising, though RBI stepping in to fill the gap in supply has ensured it does not fall off the cliff. After having seen a lot of buying being met and external factors, especially the oil, turning in its favor, we retain some bias for a bit of strength in the rupee. But trigger could only come from flows reversing for what we await. From the fundamental perspective, India's retail inflation next Monday to be followed by trade data will be of interest. It's interesting to note that the expectations for CPI is to fall further towards 4.8%. RBI's next policy meeting is scheduled only in the first week of December, so the official reaction can only be known later. But broadly, there is no expectation of change in policy from RBI till middle of next year. Thank you.
Thank you, JK. And we are seeing this emerging theme where US economy is showing some signs of slowing down. At least the data last week were weak on most of the fronts, and it seems as of now the yields have also topped out. Even when we talk about European Union, their retail sales showed a mixed picture. But what's interesting is when we see Chinese CPI was weaker than expected, both on a year-on-year and month-on-month basis. So a lot of deflationary forces are still in play over there. And probably this weakness in global demand has led to oil prices, which have decisively broken below $80. Now, this will also be positive in the fight against inflation as energy prices cool off. For rupee, nothing new to write home about. Nothing seems to be moving the rupee as of now, and the key data we have is next week, which is the Indian retail inflation and the trade data. So that would be something to look out for. That's it from us today. Thanks for listening. Tune in tomorrow for another round of fresh updates. Thanks for listening.